Welcome to the Deep Dive. We're here to unpack the key takeaways from today's major earnings calls. We've just gone through Exxon Mobil's Q1 2025 report, and, some numbers really jump out initially.
They certainly do.
We saw $7.7 billion in earnings reported. That's up a solid 4% from the last quarter if you exclude certain items.
Right, a decent sequential bump.
And cash flow from operations hit $13 billion. That's actually leading their major peers, the IOCs.
That $13 billion figure is quite significant, yeah. It really shows the underlying strength of their core business generating cash from operations.
They also completed $1.8 billion in asset sales, mostly upstream, it looks like.
Yeah, continuing that portfolio optimization trend we've seen.
A lot of cash went back to shareholders. $9.1 billion total, split between dividends and $4.8 billion in buybacks.
A very significant return to shareholders. And it ties into their longer-term performance too, doesn't it?
It does. They mentioned a 3-year total shareholder return of 60%. That's what, about 17% CAGR?
Which, as they pointed out, has beaten both their peers and the wider large-cap industrial sector. So yeah, a strong quarter from a financial perspective.
Okay, so results look pretty good looking back.
Yes.
But what about looking forward? We heard some caution from management, didn't we? Specifically about tariffs.
Yes, exactly. That was a key theme. Management really highlighted the uncertainty these tariffs are injecting into the mix.
How so? What's the worry?
Well, their view is it's kind of weighing on economic forecasts generally. It creates volatility and maybe slows down growth overall.
Oh, yeah.
And that uncertainty, plus the chance of, more OPEC supply coming online potentially, that could put downward pressure on prices and margins, of course.
Right. So potential headwinds there. How are they preparing for that? Are they ready for potentially tougher times?
They really emphasize that. They feel the strategic moves they've made over the last, 8 years have put them in a better position. And a big part of that, maybe the cornerstone, is cost management.
Ah, yes, the cost savings. They've been talking about that for a while.
And the numbers are pretty substantial. Since 2019, they've taken out $12.7 billion in structural costs.
$12.7 billion.
Wow. Yeah, if you break it down, it's almost $2.5 billion a year on average for the last 5 years. That kind of saving really makes a difference to the bottom line.
That's a huge number.
Yeah.
And they're not stopping there, are they? What are the future targets?
No, they're aiming even lower on break-evens. The goal is $35 per barrel by 2027 and then down to $30 a barrel by 2030.
So just to clarify for everyone, break-even is the oil price they need just to cover all their costs, right?
Exactly. So a lower number means they're profitable at lower oil prices, giving them more resilience. And what's interesting is how they plan to get there. It's not primarily about cutting capital investment.
Oh, how then?
It's more about growing earnings and cash flow overall, which then drives that break-even figure down through efficiency and scale, not just austerity.
Okay, so growth and efficiency driving it. Where will those future savings come from?
A lot is expected from their newer centralized organizations, things like logistics, procurement. Centralizing those functions lets them leverage their sheer size.
Makes sense. Use that scale.
Right. Get better deals, streamline how things are done, and technology is a big part too. They mentioned the Blackline software in accounting as an example, automation reducing overhead.
So it's a real operational redesign, not just, trimming the fat.
Precisely. And alongside that cost focus, they've been actively reshaping the portfolio too, selling assets.
That $24 billion figure since 2019.
Exactly. $24 billion of what they consider non-core assets divested. And they argue this actually strengthened their earnings power.
Strengthened by selling things off.
Yeah, by about $4 billion per quarter, they estimate, at current prices and margins, because they're focusing resources on the higher value, more strategic assets. It's about high grading the portfolio.
Got it. But even with all this cost focus and selling, they are still investing heavily in new projects, aren't they?
Oh, absolutely. But it's very targeted growth. Look at the new chemical plant in China.
Right, they just started up.
Yes, ahead of schedule and under budget, which is always good news on projects that size. And strategically important, it gives them domestic supply there, shielding them somewhat from tariffs, and taps into long-term growth.
Okay. What else is coming online?
Well, there's a second advanced recycling unit starting up in Baytown that's processing plastic waste, 80 million pounds a year capacity.
Interesting on the circular economy front.
And then in the upstream, 2 big FPSOs, floating production storage and offloading units, are expected later this year, one in Guyana, one offshore Brazil.
Those deep water projects, FPSOs are basically giant floating factories, right?
Pretty much, yeah. Crucial for those big deepwater developments, they'll add significant production.
Sounds like a busy year for project startups.
It really is. They also flagged 10 specific advantage projects starting this year. These are their high return assets.
And the expected payoff.
They project those 10 alone will generate over $3 billion in earnings by 2026, assuming today's prices and margins hold.
So the capital allocation strategy is still very much focused on growth, alongside the financial strength and shareholder returns.
That's the message. Invest in profitable growth. Keep the balance sheet strong. Share the success. That's the mantra.
How does that look in terms of spending versus returns going forward?
Well, total cash capex is actually set to rise somewhere between $28 and $33 billion per year through 2030.
So spending is going up.
Yes, but interestingly, the reinvestment rate, the share of cash flow going back into the business, is expected to decline from about 50% now down towards 40% by 2030.
Ah, okay. So even with higher absolute spending, a larger slice of the pie should be available for shareholder returns.
That seems to be the implication, yeah. And underlying that is the shift in production mix. They expect over 60% of upstream output to come from those higher margin advantage assets by 2030.
Which improves profitability per barrel.
Significantly. They're projecting a jump from about $10 per barrel profit last year to $13 per barrel in 2030 for those advantaged assets.
And similar trends in their other businesses.
Yes, in product solutions, they're targeting 80% growth in high-value products by 2030. That should push those products to over 40% of that segment's total earnings.
And we should touch on the low carbon side too. They have targets there as well.
They do. Aiming for $1 billion in earnings from low-carbon solutions by 2030, and they see these businesses as potentially less tied to commodity cycles.
What's the main focus there currently?
The biggest investment this year is carbon capture and storage, CCS. They mentioned their first customer is coming online now.
And they also highlighted the flexibility from short-cycle assets.
Right, over a third of their upstream production now comes from short-cycle stuff like shale. That lets them adjust activity much faster if market conditions change.
Makes sense. Did they mention any potential delays for projects, maybe in those newer areas?
They did note that projects not yet at FID final investment decision, especially in some newer businesses, could potentially be deferred.
If what?
If the policy support isn't there, or if the market doesn't develop as needed. So there's still some conditionality on those future bets. FID is that big commitment point, you know.
Okay. Let's switch gears to the Pioneer acquisition. That was obviously a huge deal. How's the integration progressing?
Seems to be going well, maybe even better than expected. They mentioned they've already bought back about a third of the shares they issued for the deal.
Okay, delivering on that commitment.
And importantly, they've actually raised their synergy estimates. They initially targeted $2 billion annually. Now they're saying greater than $3 billion annually over the first decade. That's a pretty significant jump. Suggests they're finding more savings and value than they first thought.
That feeds into the idea that maybe they think their stock is undervalued. Did they comment on that?
They pretty much said it directly. Their belief is the current share price doesn't fully reflect the company's value.
So they see buying back stock now as a good move.
Exactly. They view current market conditions as a good opportunity for buybacks, which fits right into their shareholder return strategy.
They also mentioned strategic flexibility, potentially more M&A.
Yes. They stress they're always looking at the portfolio, ready to adjust plans to maximize NTV net present value while keeping operations running smoothly. Especially in the unconventional side, they're constantly weighing those trade-offs.
And in a downturn, could that mean more deals?
They indicated it might. A lower price environment could create opportunities where they could potentially buy assets or companies and add value through their scale or expertise. That 1+1=3 idea they mentioned.
So the focus doesn't change, but the opportunity set might get bigger if prices fall.
That's the gist of it, yeah.
Okay, let's quickly touch on that Baytown blue hydrogen project.
Right.
What needs to happen for that to move forward? It's a key low-carbon initiative.
Right. They outlined a few key things. Solid policy support is one. Making sure the project delivers competitive returns is another. But the most critical factor right now seems to be securing offtake agreements.
Getting customers lined up to actually buy the hydrogen?
Exactly. Locking in those sales commitments is crucial before they make that final big investment decision.
And back to tariffs quickly. How worried are they about those impacting projects?
Their take is that existing projects, the ones already under contract, are mostly shielded. It's the newer projects coming online that have more potential exposure.
But they seem confident they can manage it.
Yeah, they express confidence they can handle the impacts without major changes to project plans or economics. They also sort of hinted they expect governments to be sensitive about tariffs hitting the energy sector too hard.
Okay. And refining. That seemed like a bright spot.
Definitely. They attributed the strong performance there to years of work, understanding their competitive position, reconfiguring plants for higher value products, selling off less competitive refineries, high grading the portfolio again.
And operational improvements, too.
Yes. Big emphasis on reliability improvements, better maintenance, safety enhancements from their global operations teams. They said that's added significant value.
What about the outlook for refining margins?
Still uncertain, they admitted, regarding the overall supply-demand balance. But they did note Q2 margins were showing some improvement. Their focus, though, is on running well, not trying to perfectly predict the market.
Got it. One last strategy point. Dry natural gas. Any change there? Still focused on liquids-rich gas.
No real shift reported. The focus remains on gas produced alongside oil and other liquids. They acknowledge some dry gas assets are competitive, but it's not the main priority for investment right now.
Okay, so wrapping up this deep dive. It feels like the main story is resilience, doesn't it? Strong results despite some market chop, driven by that cost-cutting and portfolio work.
Absolutely, and the Pioneer integration seems to be boosting that, exceeding expectations on synergies.
Key things for investors to watch going forward would be progress on those low-carbon projects, like Baytown Blue Hydrogen.
Definitely. That's a big test case. And continued execution on shareholder returns, the buybacks, and dividends.
While keeping an eye on those broader economic concerns and tariff impacts that management flagged.
Couldn't have said it better. It's a complex picture, but they seem to be navigating it proactively.
All right, that brings us to our This Is Not Financial Advice segment. Always fun. Got an outrageous but plausible idea based on this call.
Okay, here's one to chew on. Given management's talk about resilience, strong cash flow even if prices dip, and that 1+1 M&A philosophy, consider this. A long position in Exxon Mobil itself, paired with carefully chosen short positions in a basket of smaller independent producers.
Okay, shorting the little guys. Why?
Specifically, target smaller players operating in basins where Exxon Mobil already has a big footprint, and stated growth plans think Permian, maybe Guyana, Suriname adjacent players, places where Exxon has scale advantages.
Right. And the logic is?
The plausible part. If oil prices do soften, creating that M&A environment they mentioned, these smaller players in their core areas could become prime takeover targets for Exxon Mobil. Synergies, economies of scale, classic 1+1 potential.
I see. So you're betting Exxon might buy them out if things get tough.
Sort of. The outrageous part is obviously trying to pinpoint specific targets before anything is announced. It's pure speculation on M&A activity.
Gotcha. Plausible logic, outrageous execution perhaps, and the usual disclaimer applies.
Absolutely. Purely food for thought. Informational, maybe slightly entertaining, not financial advice in any way, shape, or form. Please, do your own detailed research before ever considering a trade like this.
Always good advice. That's certainly a scenario to mull over. And that wraps up our deep dive on Exxon Mobil's Q1 call. We've covered the financials, the strategy, the outlook, the challenges, quite a bit of ground.
We did. Hopefully it gives you a clearer picture of where things stand.
We'd love to know what stood out to you listening in. What are your takeaways? Agree, disagree, let us know. We always want to hear your perspective.